So alimony versus child support. Alimony is something that you negotiate. Child support, while you could negotiate it, if you tried to stiff arm and avoid it, the courts will simply force you to pay it. All right, so child support has no effect to either the payer or the payee. It's just your moral and legal obligation to provide for the children that you have brought into this world, whether you did it through marriage or not. Got to pay child support before alimony is included or deducted. IRS can keep tax funds, refunds from the custodial parent if you're a deadbeat mom or dad. Structuring your divorce decree so that payments, which are really child support, are called alimony, can generate some significant tax savings in the right situation where the payer has a high marginal tax rate and the recipient does not. So like many places in tax, we have an old saying that pigs get fat and hogs get slaughtered. And so the tax code has built into it safeguards so that you can't take something that's clearly child support, call it alimony, and then have it magically become a disappearing payment when you no longer think it's appropriate to pay child support for your child. And this restriction goes back to the very first payment that you made. So if your child is 2 years old when you get divorced, and the divorce decree is structured for any of the items on the next couple of slides, the payments were always child support. You're not entitled to the tax deduction. So we look for payments that are reduced when you no longer want to pay the kid anymore. So you want the mom or dad to get cut off. A contingency relating to your child, or a time that can be clearly associated with the contingency. And so we have these things described on the next slide. And these things apply even if you have something that's called child support, and then you've shifted more of what would be child support into something that's designated as alimony, you're still not out of the woods. So contingency relating to your child, any of these events that would be normal times when you no longer wanted to support the kid, right? So you can see the list here. Those would be normal times when a parent would stop supporting the child. So if you have a divorce decree that says alimony is eliminated or reduced when any one of these things happened to the child, it was never alimony. It was always child support. And then people are pretty clever. They try to avoid specific references to events. And so if you reduce your payments at a date associated with your child's 18th or 21st birthday, even though you don't specify that's your child's birthday, there still have never been alimony. They've always been child support. And then this extra bullet is one that simply says that if you got a bunch of kids, and rather than tying that to 18 or 21, because you know that's the kiss of death, you tie it to 19 or 20, but all alimony is reduced every time a child in your household turns 20, then those payments were always child support. So once again, I strongly suggest that maybe not so much the book, more the Pub 17 or the IRS publication on divorce would be a good place to spend just a little bit of time reading about this, just to know where the exceptions are, so that if you get a question, you know where to go quickly to find the information. Alimony versus property settlements. Back in the 1950s, if you've ever watched Perry Mason, one of the prime reasons why a man or wife killed their spouse was because it was very expensive to get divorces. First of all, they lived in California, which is a community property state, something we have not yet discussed and we're not going to. But in a community property state, you own everything he owns and she owns everything you own. And if you get divorced, everything has to be split up. So not only was divorce not socially acceptable back in the day, it was also very expensive, even in non-common community property states, because the IRS taxed property settlements as if they were taxable events. And we've already covered this idea of imputed income with the interest-free loans. And so it didn't matter whether you actually sold the building. I took 100% interest in the fishing cabin. You took 100% interest in the gold mine. We were deemed to have sold both properties, and we would both have taxable income, even though we didn't have any in cash. So in the 1980s, the attitudes towards divorce were loosening up. Lots of bizarre behaviors were resulting as people simply could not afford to get divorces. So nowadays, the division of property at divorce is a totally non-taxable event. As a general rule, you got about a year around the divorce decree to say, I'm taking this, you're taking that. And as long as you don't actually sell it, convert it to something other than the property it is not a taxable event to either party. And so if you really wanted to, you're both in the 35% tax bracket. There's absolutely no advantage to alimony. You could just sit down and decide that we've got $3 million worth of stuff. We both have good jobs. I'll take half, you'll take half, and we'd be done. You never have to deal with the tax consequences of alimony. There are about 13 slides left covering a variety of topics. I'm not going to heavily narrate them. I just want to remind you that you are responsible for these items. I would suggest that you check out the homework that I've assigned, know where all these things are, have looked at some examples in the book so that you are prepared for those tests and quizzes coming up. As a general rule, prizes, awards, and gambling are income. You measure them at the fair market value. The one major exception is when your boss gives you non-cash things for safety and length of service. So that traditional gold watch would not be a taxable event. If they give you a $5,000 bonus because you reached year 20, you'll pay taxes on it. And I did want to point out that you're going to use page 1 other income for a lot of items because they don't occur very frequently. And you want to make sure that other income is where no self-employment type taxes would be assessed. So a lot of things that may be related indirectly to employment but should not have payroll taxes assessed, you'd want to make sure that you use page 1, other income, at the bottom. It's the very last line. Then we just have a list of exclusions from gross income. All your fringe benefits, you need the word qualified in front of the word fringe benefit. And why they are a good deal is the employer gets a tax deduction. You have no income inclusion. And most of the time, you don't have to pay payroll taxes or income taxes. So fringe benefits are a good deal. And then there's some other activities, just things that are always excluded from income. And then a little bit about scholarships and fellowships. And then we'll close with those payments you get because you've been damaged, injured, all those kinds of things. So fringe benefits, remember, to be qualified to be excluded, fringe benefits must be qualifying. And basically that means that the rich guys can't get it all. So you have to make sure that the little guys get a fairly equal share. You can't have a pension contribution that gives 20% to the rich guys and 2% to the poor guys. It just won't work. The one exception to that is working condition fringe benefits. The boss can have an absolutely beautiful office and a really expensive desk and a fancy car while you give plastic and Ford Pintos to the working guys, and that would still be okay. So note that the word qualifying means that it's okay. Otherwise, it would be included in income. I did want to take a minute and talk about cafeteria plans. They're something that when you start working for a professional firm, you want to make sure you don't lose out on. Some companies take the position that not everybody needs medical insurance, not everybody needs the qualifying fringe benefits in exactly the same way. So instead of saying we'll pay for this, this, and this, they adopt qualified plans from the IRS following all the normal procedures about making sure they don't discriminate. And then they say that you can choose, if you want to take, I think, $6,000 now of your regular salary. You could choose to set $6,000 aside to pay for your medical. If you do that, it will be the same as if it was a qualifying fringe benefit. That $6,000 you will not pay income taxes on. So make sure you check all of this out when you start working for a new company. So you reduce your salary and you don't have to pay the income taxes on it. The two most common ones are to pay for your medical expenses and your child care. So if you have a relatively low insurance policy with a high deductible, you might want to use your cafeteria plan so that you didn't have to, you could pay your out-of-pocket cost with pre-tax dollars. And I did misspeak. I think after the Affordable Care Act, one of the ways they paid for it is the cap on your medical expense allowance is like $2,500 now. Child care is still $6,000, but medical dropped from $6,000 to $2,500. Remember, excluded from gross income, but you probably have to pay payroll taxes on these items. And if you don't spend it, you lose it. And it isn't that your employer gets it back. It goes into a state fund and gets used for various things. Let's see. So this is just a list of other things. I want to make sure that you do pay attention. They are things that could show up on all the quizzes and tests. Life insurance, if it's group term, the first 50,000 of coverage, there is no cost to you. Amounts over that are taxed at a deemed premium rate. And there is a table and example in the textbook. Make sure you figure it out. Most of you, if you don't already have a job where your group term insurance is more than 50,000, you will probably have one in the future. And it's good to sort of understand what's going to happen. It's not totally free coverage because you will have an inclusion on your W-2 that will increase your taxable income. Currently, all health and medical insurance premiums paid by your employer are fully deductible. If you've got the really fancy plans, that's going to change, I think, in 2016. And then no additional cost services, discussion in the book. We will have a quiz on that, so make sure you read no additional cost services. Meals and lodging. Sometimes your employer can provide you with free food, a free hotel room, apartment, and those benefits are considered non-taxable, but they have to be for the employer's convenience. So you have to have it on the premises. So you work at McDonald's, you get to have lunch free because they give you a fairly short lunch break and they don't want you wandering off and not coming back. And then for lodging, has to be a requirement of the job. All right, you are a policeman. They need someone to be physically resident in the apartment building, and they want to be able to say, hey, we've got a policeman who lives here. So they will hire you as a security person and say, in order to keep this job, you must live here. And by the way, we'll let you have the rent free. If your company is a retailer or a wholesaler, they can't just give you product free. They can give you a reduction in the cost, an employee discount. If you've ever worked retail at Christmas, one of the reasons you do that is because you can buy all your Christmas presents with a employee discount. So you can see here that there are limits to how much they can actually give you a break. There's some problems and examples in the book. De minimis fringes are things that are just too small. It's not worth talking about. So you can see the things listed here. If your company provides free coffee, Christmas turkeys, those kinds of things would technically be more compensation, and they should be valued. But the government has said it's just not worth worrying about. Cash is never de minimis. $10 needs to be included as much as $100 does. Working condition fringes are things that are provided or paid for by your employer that help you do your job. All right, and it might seem silly to have office equipment, but if you are a contractor, a painter, you are supposed to bring your equipment to the workplace. And many, many years ago, when calculators were first invented, when accounting offices provided calculators, it really was considered to be something that was giving you something you should have bought for yourself. And so the question comes, should that be taxed? And for a while, the answer was yes, but not for years and years and years, right? All that stuff at your boss's office that makes your job happen is considered to be a working condition fringe, and you don't have to pay any taxes. Parking specifically at the business, if you have a parking lot and you are offered free parking, that is considered a working condition fringe. And then it is just an example here of how packaging can make a difference. If your company pays your dues at American Family Fitness, that is income to you. It will be in your W-2. If they put a gym on the premises, you can use it for free and you don't have to pay anything. So how you package and tax can make a really big difference. Qualified transportation fringe benefits are relatively new, probably the last 10 or 15 years. You're going to learn in Chapter 6 that the cost of getting yourself to work, parking your car, getting yourself home are non-deductible personal expenditures. But sometimes employers like to help employees out with these things, and so they change the rules so that if the employer does it right, they can pay for your bus ticket or your transportation and not have income to you. So it must be paid for by the employer, so he can't give you cash to buy a bus pass. He has to actually give you the bus pass. Cannot exceed specific dollar amounts discussed in the book. They are indexed for inflation, so they change every year. So your employer can provide for a van to take people to and from work. He can provide you with a bus pass, or he can provide you with a parking place. Now, traditionally, if the business property has room for parking and you get free parking, that was never a taxable event. But not every employer has a parking lot. And so if people are working downtown and parking is expensive, it was not unusual for an employer to pay for your parking, pay an outside vendor for your parking. And prior to this provision, that would have been a taxable event, while pulling up out front to Target in parking for free would be a non-taxable event. So this provision evens that out a little bit. And then there's just a bunch of other things that are always excluded. But when I say always, remember there are exceptions, all right? Life insurance proceeds, if you are strictly the beneficiary of grandma's life insurance policy, that is not a gross income event. But if you are the butler and you took care of the guy for 30 years, and in return he said when he died, I'll make you my beneficiary, technically that is income. And if you ever told the IRS that, they would say you worked all those years for that life insurance, so it should be income. Gifts, true gifts, are never income to the recipient. An employer never makes a gift to an employee. Under very unusual circumstances, would what your boss gave you not be some sort of compensation for the work that you're doing? True inheritances are not income either. And in all forms of welfare payments that I'm aware of, child support, food stamps, all of those are not considered to be gross income. A true scholarship or fellowship is excludable income, but only if you got to be a degree student. So if you're not seeking a degree and they give you money, that is a taxable event. You cannot provide services. So if you are a doctor in training, you're an intern or a resident, it is true that you're learning, but any monies they pay you are income to you because they're paying you to provide medical services to people. So if you do grading, if you do anything that is a return, then the cash is wages just like everybody else gets. And you can only exclude the amount spent on tuition, fees, and books. So if you're an athlete getting a full board scholarship, you will pay taxes on the room and board. If the school is paying for your medical fee for your insurance, you'll pay taxes on that too. And then a few slides closing talking about when you're paid because you're injured, sick, or other damages. Workman's comp, that is different than unemployment compensation, right? If you are injured on the job and they deem you worthy of collecting payments, those are not taxable income to you at all. Other disability payments depends. If the employee pays the premium themselves, you can exclude. If the employer is paying the premium, then you can only exclude if for permanent loss of bodily function. Some policies will pay that if you lose a finger, you get $2,000. But if you lose 5 days of work, they'll pay you. You'd have to include income for the lost days of work, but you would not have to for the loss of that finger. And in physical injuries, these rules changed 10, 15 years ago. Physical injury means your body, right? You only get to exclude the compensatory damages, not the non-punitive. So you are damaged by a drunk driver, he breaks your back, and the jury gives you $500,000 to compensate for pain and suffering, and then adds another $1 million to shame and punish the guy because he was driving drunk. The $1 million would be income to you because it was over and above the amount of damage that was caused. And there's an exception for wrongful death, so maybe my drunken driver wasn't a good example. But if the jury determines that the payment is for wrongful death, it's compensatory, not punitive. So you can see how these rules can be a nightmare. We're going down the middle. So if you are injured in a car accident, your compensatory damages, you're physically injured, your compensatory damages are not included. Any punitive damages would be. And then other personal injury that's not physical, you have to include all the payments that you get. That would include damage to character, alienation of affection, somebody steals your boyfriend. And sometimes a spouse will give up custody for a child and receive money. All right, and that is a taxable event. And then lost earnings, that will almost always be income. So you sue somebody for any of the things we're reaching here, you can assume that that will generate taxable income because you're replacing earnings that you otherwise would have included in income. And just a quick reminder to remember all the things that have to be done if you want to be successful. The Blackboard quiz will reference this set of PowerPoints. 1 week after that Blackboard quiz closes, this material will show up in group quizzes and mini tests. So between then and now, check out the book examples, especially where I said to do so. Try to do as much end of chapter problems as you can make yourself do. If you're too busy to do it all, at least read some of the answers. Remember, don't read the book cover to cover, because the book is an encyclopedia, and that's not a very good way to learn things. And also remember that when it's time for those tests, especially the mini tests, you will be tired because you will have been up for 1,000,000 hours. So substitute preparedness for sleep, and that will help keep you going. See you soon.